Welcome back. This is our second edition of the weekly rate update. I'm here with John Paul. We're going to talk about market conditions over the last couple of weeks and where we're headed over the next few weeks. And specifically, what's going on in the trucking market as it relates to spot. Now, a couple of things that I've heard over the last, actually this week, is I was in two meetings. One was with a very large enterprise-based carrier. And I asked the question, are they seeing softness? And almost unanimously, everybody just said, yes, absolutely, it's very, very soft. And I was actually surprised at the veracity and almost the aggressiveness of their response. And the second was, I was talking to a smaller operator yesterday that operates predominantly in the spot market. Yep. They were 150 trucks last year, and they're down to 75. And they've split their fleet by half simply because they can't keep the drivers running. We've also seen that larger enterprise carriers, the big guys, are actually able to find drivers much easier. In fact, there's discussion that their trucks are fully booked. It's a change in the market, JP. What are you hearing?
No, I mean, we're hearing the same thing, that capacity is still readily available. I think one of the challenges for asset-based carriers that 3PLs haven't necessarily been faced with is the cost inflation that happened over the past 18 months. So if you're a 3PL or a freight broker, you might be buying capacity on the spot market, but you're selling it at contract prices. And that's, in those contract prices, those paper rates can move with the market. But if you're an asset-based carrier, a big part of your cost structure is driver wages. You know, they raise those by sort of like low teens over the past 18 months.
I was talking to a fleet that has a lot of owner-operators, thousands of owner-operators, and they said that their cost in 2 years have gone up by 28% for purchase transportation. Significant increases in overall cost.
They've gotten what they've wanted, right? Like
the drivers or the operators?
The carriers. You know, they've solved the driver shortage.
Well, they saw the driver shortage by increasing rates, and I think it's a flight to quality opportunity for. So if you look at if you contrast the larger fleets that have paper rate or contracted business, or we'll call it committed business, they're able to keep the drivers running on a consistent basis. These are companies that aren't taking a lot of freight from the spot market.
Right.
So drivers are seeking out those carriers.
Now the carriers can be choosy about who they
That's
who they
exactly
hire.
right.
Yeah.
So they have the ability to fill out all those trucks. I'm hearing some of those very fleets are actually growing their truck count in this market.
Interesting.
Because even though freight's soft, they feel like if they can keep the utilization high, then there are economies of scale. And it's sort of this different market where it's soft. Pricing there's no upward pricing pressure, but more importantly, they're able to keep their drivers running, which means that they can actually source drivers.
Volumes are good, and importantly, the turnover rate for those dedicated jobs is much lower. You know, drivers get predictable miles, they get home.
You're talking about dedicated contract, or you're talking about committed business?
Dedicated contracts.
So stuff that's contracted every single week, you expect it.
Those drivers have a better quality of life, and they don't turn over as much. So if you could grow that part of your book of business as a carrier, now would be the time to do it.
I mean, it seems to me that the larger, particularly the public carriers, are while they're faced with the same market conditions, this is an opportunity for them to really refine their operations and operate efficiently.
Yeah, we've heard, I mean, listening to the earnings calls of publicly traded carriers over the past 2 years, even when the spot market was really high, we heard from companies that they were trying to move away from irregular over-the-road, capacity.
They wanted less spot exposure. Even they knew at some point that the market would turn.
And it requires so much more work and so much more back office support to utilize those assets efficiently.
I think it's sort of underappreciated about the spot rates is when the spot rates are high, it still takes a lot more administration headaches because you're dealing with exceptions, you're dealing with locations that don't have drop trailer pools. It's just a lot of things that take your capacity out of your fixed network.
We published an article earlier this week about some of the forward curves in the regional futures contract.
Remind us what a forward curve is.
So the forward curve is in the trucking freight futures market. the monthly contracts on specific lanes, what they're being priced by the market,
what's being bid, right?
Yeah, what's being bid, for July's monthly average, say from LA to Dallas, or the national average, or a regional average. You can have a contract for July, contract for August, September, October, November, December, going forward 18 months. And those different price points along that 18 months, that's the forward curve. And it gives you pretty good price discovery into the future of the spot market, because unlike other commodities, say like crude oil, there's no carrying costs, there's no storage costs, there's no things that affect your ability to deliver a commodity in the future. That doesn't apply to trucking. So you're really getting a kind of a straight view into...
It's just sentiment, right?
Yeah,
right?
yeah.
And how are people thinking about, that are willing to risk money,
Yeah.
how are they thinking about the freight market?
Yeah, what's interesting is, looking at it, say you're not a participant in the spot market, you're an asset-based carrier, but you want to know what the market thinks about where rates are going to be in the future, and especially you want to know, where should I position my assets and when.
So what are we seeing?
We're seeing a spike and a peak in September for the Chicago to Atlanta lane. In November, we're seeing a big spike in LA to Dallas. And then, of course, December, Christmas tree season, it's the Seattle to LA.
So one time of the year that you want to be in the Pacific
Yeah.
Northwest,
And
if you're a trucking company.
Right, exactly. So, I think it makes sense. There were really supportive container volumes in June coming into the West Coast ports. They've recovered a lot since the spring. So right now, TEUs, 20-foot equivalent units hitting the West Coast, are still under 2018 levels. They're above 2017 levels. So out of the past 10 years, only 2018 is higher than this current year.
So I'm going to ask JP, let's talk about where you think price is going as is today. Is there any signs that we are at the bottom or near the bottom? Or is there signs we already have hit the bottom on the way up?
I don't think we're at the bottom right now. We're still coming off
Bottom for volume or price?
price.
So spot rates you think actually could be under pressure for a period of time?
I think August, for example, is pretty soft usually, right? We've seen rates deteriorate slowly on the more volatile lanes in July, coming off the June kind of bump. So yeah, I think we're getting into a trough, and hopefully September, October.
So we have a base in August, and that could be the low of the market.
Yeah, I think so.
And then if we can get a V-shaped recovery, which is basically, it really is, it's sort of a graph. It's not even a V. It doesn't bounce. It just sort of bleeds off. I think, assuming that we can get some level of bounce back in September, that could be a positive sign for the fourth quarter.
There are a lot of parts of the economy that affect trucking and freight that haven't been doing great, like industrial production and business investment. But one part that has been doing pretty well is retail spending and consumer spending, and that's really, that fall sort of holiday season is going to be when that can really make an impact on freight markets.
July and August are going to be extra soft this year.
Yep.
September, I think, as you stated, the thing that we're not seeing that you would typically expect to see is a lot of that September freight is really related to retailers pushing stuff into supply chains to get it into their warehouses prior to the holiday season.
Right.
I think, frankly, because of the inventory build over containers, we're not going to see a big September. I think we're going to see a relatively soft September, is my guess, just because the freight's already on shore. We'll see. I mean, it's
definitely a possibility, but like I said, we're not seeing super depressed numbers hitting those ports still.
Okay.
Like it's still, it's between 2018 and 2017, which for me is a healthy number.
The ports are still pumping out volume.
Yeah.
And I think as the consumer goes. So we'll see how that works. There is a lot more inland ports, though, that are also have stored a lot of capacity. If you talk to the warehouse operators, they're beyond maximum utilization. One of the large REITs talks about 85 is optimal, and they're in the low 90s right now in terms of utilization. So
and that goes for places like Ontario, Joliet, but also markets like Laredo.
Laredo, I think when Trump talked about shutting down the border, I think you had talked to some real estate agents that said there was just this mass demand.
Yeah, there was a literal bidding war for warehouse space just on the other side of the border.
Just so that you wouldn't be caught off guard if there was a supply chain shortage. So September, we think we could have some rebound in demand. And then I think it's all about the consumer in the fourth quarter.
Right. Right now, a lot of people aren't buying houses. New existing home sales have been down for 16 months straight, largely because the median home price is at a record of like $285,000. So people aren't buying houses. Maybe they'll buy other stuff.
Yeah, I think certainly the folks that would be buying houses, younger people who are looking for their home, just don't have discretionary income, particularly in markets that are already overpriced and overheated. So anything looks short term? Any news that's a promise? Or
I mean, I guess it depends on who you're talking to. Spot rates are falling back down, like we said last week. The shippers kind of know what's happening. They're coming back to their customers, asking them to knock down rates. And I think people expect spot volumes to stay weak, and it's still kind of an aggressive bidding for contracted, committed paper rate freight.
Got it. Well, it's great to have you here again on our second edition of the weekly rate update. Join in next week. It's every Friday here on FreightWaves.com, and we're going to take you through the week. One of the things that we're going to be talking about over the next few weeks is the impact of IMO 2020, the new maritime oil emissions law that goes into effect January 1st, which is going to have an impact on the domestic ultra-low sulfur diesel market, and that could create more bankruptcies or financial pressure in the trucking spot market fleet. So we'll pay attention to that. We'll dive into it next week. Over the next few weeks, pay attention to FreightWaves.com and our new American shipper as we dive deeper into the subjects that matter to you most. Thanks for tuning in. We'll be back here next week.